today we're going to talk about the power of the 20-period moving average. Before we do, as always, it helps us enormously if we can just make sure that the technology is working in our favor rather than fighting us. So for those of you joining us here for the live call, it'd be great if you'd just be kind enough in the chat box just to confirm that you can see the slides and that you can hear my voice. That would make for a good start. Cynthia says all good. That's great. Fabulous. Thank you. Thank you. That does help me enormously. That's brilliant. So we're here to talk about the power of the 20-period moving average, a very simple tool, but one, once you realize, how to use it properly, can be an enormously useful tool for your trading activities. And it's one that, I utilize myself in my own trading. So I'm going to be sharing some of those details with you today. So, as I said, we're going to talk about the power of the 20-period moving average, but in terms of the agenda, we'll look at, why is the 20-period moving average of interest to traders? Well, what is it that makes it useful? And in particular, and what will probably be of most use to people is how can we use it for both trend trading and also for reversal tradings. And that's what we'll be looking at there. And then, as always, as part of our Monday Market Matter sessions, we will talk about, how does it play out in live markets as we get ready for the opening of the US session. It would be interesting to know, of those of you joining us here today for the live session, how many of you utilize the 20-period moving average already in your own trading for in whatever way or for whatever reason. If you do, it'd be good to hear what your own experiences have been, and you could place them in the chat box. As always, if you're joining us for the first time, my name's Paul. I've traded for many years, traded for funds, traded for clients. Primarily, I tend to focus on trading FX indices and commodities. I tend to be a trend trader for my longer-term swing and position trades, and a mean reversion trader for my shorter-term intraday trader. And so the 20-period moving average helps in all aspects of that. And so, as I said, I'll be sharing some of those ideas with you that hopefully you can take on board and utilize yourselves as well. So, as always, if you're joining us for the first time, Monday Market Matters is our regular webinar series at 2 o'clock every London, where we try to cover an insight into the news for the news for the week ahead. Mostly we'll focus on education, and as I said, today we'll look at the 20-period moving average. We'll always have a little look at some of the platforms and tools that are available to you as an ActivTrades client, and we always have a little look at the live markets as we start the US session for the day and for the week. And after kind of last week's interesting news and price action, it promises to be another interesting week ahead for us as traders. Therefore, we always begin with a little look at the news, and I repeat it every week, that if you are new to trading, if you're just starting out on your trading journey, I would not expect you to be able to effectively analyze all the economic data, but it is important that you know when that economic data is coming out, because those kind of volatility spikes that it might bring in could either help or hinder your trading decisions. So it is important to know when that data comes out. You can do that utilizing an economic calendar. There is an economic calendar on the ActivTrades website, that you can tap into. And there are other ones available on the internet, so there is no excuse not to know, when the kind of that big major data is coming out. As I said, for new traders, it's important to know that, just so that you can see and understand when there might be volatility spikes associated with that particular data. So when we look at this week ahead, it is a much quieter week as opposed to last week. Those who joined me last Monday, we talked about the kind of major data that was coming out of the US last week. So we had, I think it was JOLTS job openings on Tuesday, we had FOMC Wednesday, we had NFP on Friday, we had, closer to home for me, we had UK Bank of England on Thursday, and and a raft of other major data points. And also we had 5 of the Magnificent 7 US tech stocks also sharing their earnings as well. So it was a bumper week in terms of market data. And when we look at the live charts in a short while, you'll see, the impact that that had. But this week is a much quieter week, and I suspect what we'll find is maybe because of all of that data we saw coming out at the end of last week, there will have been lots of institutional teams spending their weekend analysing that, and hopefully what we'll do is we'll start to gain a little bit of more clarity about the kind of narrative, direction, and trajectory of markets for the remainder of Q1 of 2024. So, as I said, that will have an impact. But when we look at this week, okay, we have had we've got a range of kind of service PMIs coming out today, and also in one or two other days during the week, and they are very useful indicators of let's say, the health of both, the overall economy, but also the manufacturing, the services. So we had manufacturing kind of last week or two before. We've had a range of service PMIs from, as you can see there, from quite a few countries and zones. We also have sort of what will be overnight for us, certainly us in, let's say, Western Europe and the US. Tonight, tomorrow morning, we have the Reserve Bank of Australia. They have their monetary policy meeting. And whilst there is no real expectation for any change in terms of either a hike or a cut, naturally, traders and investors will be keen to see the associated statement in order to interpret whether there is a change of sort of mood and narrative with that. We've got Canadian and US trade balances on Wednesday, and whilst they are useful insights, okay, they do not hold as much weight as perhaps things like sort of the inflation data that we've seen over the last year, 18 months. However, with Mr. Trump over the weekend sort of hinting that he would put I think like a 60% tariff on Chinese exports, then of course that traders will start to take that into consideration, especially when they look at sort of trade balances, and that might well be something that becomes of more interest depending upon how Mr. Trump does in the run-up to the US elections. So we've also got a bit of Chinese data there, okay, and traders and investors are increasingly interested in what's coming out of China, because invariably there's very little that is let's say rosy in terms of the economic news, and of course that has huge knock-on impacts, in particular to proxies like Australia and the whole of Pacific region. So traders do take an interest in that, and then we have inflation figures from Germany and some Canadian employment data. So there is a range of data coming out this week. It is not as heavy and hard hitting as the data from last week, but as I said, what we might see is start to see sort of the clarity on the overall narrative as we look at the live price action as it develops this week. So that was looking at the news, and let's have a little chat about our main educational piece today, which is all about the power of the 20-period moving average. Now, as the slide says, we often see many new traders overcomplicate their trading systems, which actually ultimately leads to degraded performance. Very often new traders feel that having more and more indicators on their charts will help with their decision making. Whereas the reality is that it often leads to analysis paralysis, and in fact what tends to happen is the trader actually ends up making no decisions because they are overwhelmed by the data and are unable to sort of operate with any real clarity in markets. So today we're going to talk about what we could do to help us strip back those kind of need for more and more indicators, and I'm going to share with you two simple ways that we could trade markets for either trends or reversals using a simple 20-period moving average. Now, what I often find, as a trader of many years' experience, is that new traders, they kind of tend to love to overcomplicate their trading methods, their trading systems. I've been guilty of it as much as the next man. Okay, in the start of my trading career, that we think a trading system cannot be that simple, that we need to add more to it, that we need to overcomplicate it. Okay, and in fact, I'm here to tell you that it's actually normally the exact opposite. That actually the easier and the simpler and the clearer your trade method is, the more effective you can be as a trader. So let's talk a little bit about that, and in particular how we could use the 20-period MA to help us. So very often, especially in, let's say, sort of today's, you kind of often find that on social media, simple moving averages get a very bad rep these days in trading. And if you are at the absolute beginning of your trading journey and don't really know what a moving average is, I think if you go back into the ActivTrades webinar archive and look back, you will find that there are a couple of videos that just talk specifically about moving averages, how they're created, what are the different types, okay, and how not to use them, and actually how to use them. But if you need to sort of get that insight. But as I said, they get a little bit of a bad rap these days in trading. However, and I've used them myself and have done for many years. They can be very, very useful if used correctly. As a general rule, I suggest not using moving average crossovers as a trigger. I have one or two of my own trading methods that might have elements of that in there. But as a general rule, I tend to tell traders to ignore moving average crossovers. And if you don't know what that is, here I have what I normally have is a blue 20, a red 50, and a green 200, simple moving averages. And very often what traders will do is they'll invariably buy once a faster moving average crosses a slower one. Now, and that's, people love that because when in a very, very clear, strong, dominant trend, it looks fantastic. Okay, as you can see there. But very often happen is, remember what I say is that markets only trend for 20 to 30% of the time. A lot of the time, markets might be just going consolidating or going sideways. And what we have here is then the moving averages tend to get a little bit crossed, and you get a little bit whipsawed. Okay, so as a general rule, I suggest ignoring moving average crossovers. Okay, there are caveats to that, and there are ways to do that, but for a new trader, that's what I suggest. However, they are very useful as dynamic support and resistance. Okay, what do I actually mean by that? Let me just clear up this page for us. What I mean by is what we'll see is that most traders like to utilize a version of support and resistance, whether that be levels of support resistance, maybe that's big round numbers, maybe that's supply and demand, okay, maybe that's sort of order blocks of one sort or another. There are lots of different variations, lots of different ideas, but ultimately it is a place where there will be either support or resistance, and a moving average can act as a very good dynamic. And what do I mean by dynamic? Well, by dynamic means that that it is constantly moving, it's constantly updating, because a moving average, remember, is created that a 20-period simple moving average is invariably once a candle closes, the last 20 closes are basically added up, and then an average of that is taken, and that average is plotted, and that's the moving average. So it is dynamic, it's constantly moving. But what we see is that invariably it can be very useful as in an uptrend, as an indication of dynamic support, or in a downtrend, an indication of dynamic resistance. And that can be useful. Okay, I'm going to talk a bit about that today. That can be very useful. It can also help us, give us an indicator of the strength of the trend. And what I mean by that is invariably is that once we start to see, when the moving averages are all here, coiled up, as you can see there's the 20s, the 50, the 200, and they're all a bit coiled up there. Okay, that in itself can tell you that there is no trend. What we actually like to see is, as you can probably see here, is that we know that price is basically moving. Price never moves in a straight line, but we want to identify that there is a trend. And once we start to see those moving averages start to fan out, that is another good confirmation for new traders that we are into a trend. The trend has an indication of strength, and that can help traders, just basically confirm to them which way the trend is and which way they should be directing their trades. And as you'll probably hopefully by the end of this session now, they can also be a good, useful indicator of the confirmation of the end of a trend. Okay, they can start to give us an idea of when that trend might be ending, and we'll talk more about that later. So, as I said, they get a bad rap, okay, because people try to use them for moving average crossovers, whereas in fact, actually, there are different ways to utilize them, and they can actually be very, very helpful for a trader if you know how to utilize that. So, as I alluded to earlier, I tend to use a 20-period simple moving average, a 50-period red, and a 200-period green. Okay, and I just use simple moving averages, and What I will discuss today, you'll find that I utilize simple, but some people would use exponential moving averages. I am comfortable if whether you're using a 20 simple or 20 exponential, the difference isn't big enough to really to affect this. But there are lots of different ways, lots of different types of moving averages. But I generally tend to use for the major ones just simple moving averages. Okay, others may differ. That's absolutely fine. As I said, I just want to keep things nice and simple, nice and easy. I'm focusing more on my decision making more so than on overcomplicating the picture. So here it is a very simple way to utilize the 20 period moving average as a way to rejoin trends. And I call it the 20 MA mech entry. It's kind of mech because it's almost kind of mechanical. And as I say, it is looking for a way to join an existing trend. Very simple setup, very simple execution, okay? Simple moving averages with a simple setup and a simple execution. And it is viable across all time frames, but I would primarily use it on the 4-hour chart. Now, as I said, you can utilize it across all time frames, but I am a full-time trader. I have alarms, in my system, okay, to warn me when the next 4-hour candle is just about to close and when it's about to start, so I can come to the charts and identify, if there are specific setups that work for me. I appreciate others may not necessarily be able to trade 4-hour charts, okay, because I think their lifestyle commitments. Hence why it is viable across all time frames. It's just through experience and my own results, I find that 4-hour trading tends to suit me better on that sense. So what are we talking about in the mech entry? It is a very simple setup, okay? And we want to utilize the 20 and the 50 simple period moving average. Remember that, I'm on a blue 20 and a red 50. So for a buy environment, okay, for an environment where I'm looking to be long, what I want price on the daily chart, okay, to be above its 50 period moving average. Okay, that's the red period moving average. For me, that is enough of a filter to recognize that, I'm in a buying environment rather than a selling environment. Also, price on the 4-hour should be above both the 20 and the 50 period moving average, and also making higher highs and higher lows. Okay, indicating just good trend trading, and people who are just enjoying trading trends, okay, might keep it very simple like that, and this might just be an additional help, okay, in terms of confirming trends and confirming ways to sort of join trends, because sometimes, especially in strong trends, it's not always as clear how to do so. So once I've done that as my filter on the 4-hour chart, as I said, I want price to be above the 20 and the 50 period moving average. In this case, we've seen that it's also been above the 20, okay, it's also above the 50. And then what I see is then price then retraces beneath the 20 period moving average. So in this case, that would be kind of point X, this candle here. It closes, okay, beneath the 20 and also the 50, but beneath the 20. But what we look for is then price then rallies and closes back above 20 period moving average, and that's this candle here. Okay, hopefully you can see there. It closes back above the 20, all right, back above the 20. That becomes your trigger bar, and what you're looking to do is you're buying the open of the next candle. So if you trade like this on a 4-hour chart, so as I said, I'll be ready for when the candle gets ready to close and ready to move, or rather the next candle to open. But this might be a 5-minute chart, okay? This might be a monthly chart, okay? The setup is very simple and very simple to identify and execute. It's just about, if you are going to use other time frames, finding let's say the right filter time frame that would be suitable. So, as I said, for me, I use it on the 4-hour chart with the daily as a little bit of a simple filter. As I said, buy the open of the next candle. So when this candle closes, we've closed above it, and bang, we are buying the next candle. And our stop loss would be beneath the low of the last 2 bars, okay? But, the only reason I'd caveat that with that is that, like the very, very old and perhaps rude trading adage, don't be a dick for a tick. In this particular case, okay, even though my entry's here, I would be placing my stop loss beneath actually this swing low. That's what I'd be doing, because the distance isn't great, but that I just believe would be a smart move. So, place your stop loss beneath the low of the last 2 bars, but also be aware of the context that you find yourself in. Okay, there's no need to be. The important thing is that we are placing a stop loss and we are managing risk accordingly. That's what we're after. And then with that in mind, in terms of our exit, so we know what our entry is, we know where our stop loss is, our exits, well, in terms of profitable exits, we either target the 261 fib extension, okay, or fib expansion of that trade range from where our entry is to our stop loss, or if you just like very simple fixed, then I always suggest a 1.5 reward to risk. Okay, that's what I suggest. If you are somebody who prefers a trailing stop, that's the way, then I suggest you utilize a 3-bar trailing stop. So namely, every time a candle closes, your low gets moved, your stop gets moved beneath the low of the last 3 candles. And that can actually be quite useful, because you start to very quickly get an idea of, where when price is starting to effectively sort of close up a little bit, well, then we're starting to sort of see that, we're realizing bosh, bang, where we're likely to get taken out. So I appreciate that some people really like to use trailing stops. I tend to be a targets man myself. Okay. What I always say about whether to use a target or a trailing stop, there is no perfection. And what is important is that, what can you commit to following trade after trade after trade for the next 20 trades. That is actually what's important. All right, that's what's important. So that's a very simple long setup. Okay, price above the daily 50 period moving average, price above the 4-hour 20 and 50. Price then pulls back beneath the 20 period moving average. Okay, it's a pullback, and as price re-exerts, okay, it re-exerts and closes back above the 20. That is our entry trigger. By the open of the next candle, stop beneath the 2 bars last low, or the kind of the very recent swing low, and then you're targeting either 1.5 reward to risk, 261 fib expansion of the range, or a 3-bar trailing stop if that's the particular way that you like to sort of manage your trades. That's the important thing for you. So just looking at looking at that here, do you think that's a simple setup? Do you think that is something that could actually sort of you could sort of build into a trading plan? It's what we're looking for is we're just looking at it as a way and a means to rejoin the dominant trend. That's what we're looking to achieve. So a couple of very, very simple. Simon says that's a great setup. Thanks. You're very welcome, Simon. And it's very simple. Okay, it is very simple, and it's a way and a means for you to try and join the dominant trend. That's what we're looking to do. Okay, and as I said, sometimes we overcomplicate it, and I have been as guilty as the next man of that in the past. Okay, we try to overcomplicate it. We try to make it really special. And in fact, actually, we're just trying to join the trend. Okay, we're just trying to join the trend at a natural point. We know very quickly, okay, where we're wrong, and we give ourselves an opportunity when a trade runs to generate an asymmetric reward to risk. And that's really, that's what we're trying to do. We're just trying to keep it simple to be able to utilize. So pound against Aussie here. We're going to talk about it how it's above the filter of the daily chart. We can already see, we can actually already see the bang. We've got a big power bar there. We've pulled back. Okay, we've closed beneath the 20 there, haven't we? And then what happens is we reclaim the 20. We reclaim the 20. Okay, and we're buying the open of the next candle. Stop beneath the low of the last 2 candles, but also you'd be looking here at those kind of fractals, those swing lows. Right, I might be saying, well, actually, do you know what? My stop will be there. And then you're looking for about 1.5 to 1 of your trade range. Okay, or 261. Okay, well, that'll be in that kind of region. Or perhaps in this particular case, you're invariably sort of trailing it on a kind of a thirds and stuff, and so which case just quickly bang heads you'd have been getting ready to be taken out there. Okay, so here's the thing, using a trailing stop, you'd have had a fantastic run. If you'd have been using a target, you'd have made less pips. Okay, you'd have less reward to risk. But as I said, it's neither of them is perfect. Okay, neither of them is perfect. It's like what can you execute for the next 20 trades? That's where we're looking. So yeah, so just a few examples here of trying to get into the pound against Canadian dollar. Okay, for a lot of people, I think that this would probably be a kind of very nice simple way. You can see that we're above the filter, price gets above the 20 and 50, it pulls back beneath the 20s here above the 50. This candle here is a big candle. Some people may have bought that, but what you're looking at is your trade risk. Okay, it becomes quite significant. Okay, this is a candle that's significantly large in the ATR, and for many people that would have put it off. Now, I appreciate with hindsight you can look at it and say, well, actually it did work out, Paul. But that's right, it's always easy in hindsight. All right, it's easy to take great trades in hindsight. But what is really kind of interesting is we see here the candle here comes back, closes beneath the 20, doesn't it? And then the next candle we reclaim the candle. Okay, reclaim Bosch, and there you go. There's one entry, and then what we see is we push up, then we fall back down. Okay, we're back beneath the 20, and then what we see is this candle here. We close back up above the 20, and whilst your stop would normally be here, you might be saying, well, actually, Paul, the swing point is there. That is a bit more of a kind of smart place to place my trade. And then, as you can see, it's what we're looking to do is just looking to find our way to rejoin a very simple trend. Okay, we're not overcomplicating it; we're just making it as simple as we possibly can. So yeah, so there's a few examples here, okay, and pounding against New Zealand dollar, you probably get the idea. I trade a lot of sterling, which is what I do. We're above, okay, and as I said, lots of people would use moving averages as as dynamic support and resistance, and hopefully you can see there it's showing really good way. But here, this candle, we close beneath the 20, okay, and the next candle closing, and some people might be saying, well, all right, maybe we're looking to go short, but then actually we get spinning top, and then the next candle we rejoin. Okay, bang, very strong. We're rejoining the dominant trend. Okay, the dominant trend, and then bash. That's our opportunity to get in board with our stop beneath the low of the two candles, and in this case that is also the swing low, to get a chance to sort of ride that particular trade as well. Okay. Cynthia says, do you use the pivot point to help with this trade? Not really, not particular, Cynthia. I think pivot points are very, very useful on an intraday trading basis, but as a general rule for me, on the 4-hour chart swing trading, that pivot points don't, they're not really terribly relevant for this particular setup. On an intraday basis, that they might be very useful and helpful to you, but not once you're sort of getting out to swing trading itself. Hope that helps. But thanks for the question. Yeah, just on the opposite side of it and such as well, pounding against New Zealand dollar, but on the short side, and it's really the trade is effectively it's the reverse. Okay, so we would want price to be beneath the daily 50. Okay, price to be beneath the 20 and the 50. We can see we're in a trend here, can't we? We pull back up. We have a little bit of a there's already starting to give you a hint that we're going to reverse here. In this case, that is a fine setup with our stop, and actually, we got what happened is we actually got nipped out. We just got nipped out here just by a couple of pips on our stop. Welcome to trading. All right, welcome to trading. That's that's what happens to us. But then actually, what we see is price basically, Bosch, it reverses beneath it. That one I didn't take, and the reason I didn't take is because that actually happened overnight. Even I have to sleep at times. Okay, but what we see is if you had been awake, if you're in the Asian range, you'd have been opening there with your stop above, 2 candles back, and you could have seen the run. But actually, what happened is the next day, we got the re-entry there, okay, with the stop beneath the stop above the high, and the move there, and then price pulls back again, closes above the 20, and then it basically closes back beneath the 20, and it's also a nice bearish pin bar. So if you've got price action confirming it, that just gives you more confirmation, before price runs down back towards its recent support levels there. So you had effectively there's 4 setups there. One fail, 3 wins, but the reality is it was 2 wins, because actually this trade, whilst it's a perfect setup, if like me you're just trading European session, that you'd have missed that. Okay, but welcome to trading, right? But that's what trading's like. Okay, that's what trading's like. So hopefully that gives you a little bit just of insight into how we'll see it work. Yeah, and just more examples of it. Okay, and hopefully you can see that as I said, it's price is already starting to demonstrate in a trend. What we're looking to do is to use it as a very simple way to rejoin the trend. Okay, when the dominant trend re-exerts itself, we want to use that as an opportunity to get on board. That's what we're looking for. Okay, and it's I wouldn't necessarily say it's elegant in terms of entries. Okay, it's quite simple, it's quite agricultural, but actually the longer you trade, the more you realise that is absolutely fine. You know, and sometimes we spend far too much time and energy trying to find the perfect setup, and there is no such thing. You know, sometimes you just need to have a very simple entry setup that allows you to just join the trend and let the numbers work out in your favour. So just a couple of caveats. I think we saw it on one of those pound against Aussie setups, namely if the trigger bar is large, okay, then either give the trade a miss or look for a retrace, okay, of between 30 to 50% of that particular trigger bar. So this is probably a good example here. Okay, you can see that here, price has been in its trend. It closes beneath the 20, then it closes back above, and that would be your kind of your first entry. But then your second entry, you might see that. But as you can see, the trigger bar is huge, okay, compared to the others, okay. So some people would take it, and some people would say, well, yeah, take it, Paul, because basically, it did work. But that's hindsight, okay. So it's easy in hindsight to pick which ones worked and which ones didn't. What I'm saying is that if you have a very large trade range, well, then invariably price needs to move a considerable distance to generate the asymmetric reward to risk that we're looking for in our trade setups. So that was the 20 MA MAC entry, and it is just a very simple agricultural way for you to join a trend. I said I'd also share with you a way to use the 20 period moving average for reversals. Okay, and this is, you'll sometimes hear me refer to it as the PO20. And this really is the power of the 20 period moving average, and it being used, to confirm of a reversal. So in an ideal world, what I want to see is that price may have printed a reversal pattern, and then I'm looking to use the 20 period moving average as confirmation of that reversal. We watch to see how does price react to the 20 period moving average after the reversal pattern. And this is where is that moving average, is it providing dynamic support in a bullish reversal, or is it providing resistance in a bearish reversal? So here's an example here. Okay, price has been in a nice downtrend. Okay, and actually when we can see price comes up to the blue 20 and pushes its way down. Okay, and there it's acting as dynamic resistance, isn't it? It's acted as a place where price has reversed off. But then what happens is we print a double bottom, okay, which is in itself a reversal pattern, and traders, depending upon their aggression, might already start to get long here. But then what we see is initially we see that price struggles to get above the 20, but then once it starts to close, the 20 flips. Okay, the 20 flips from being resistance here to now turning and being support. Okay, and that's what I want you to focus on. 20 becomes the support, price rallies up again, price comes back down, and even though price pierces the 20, if you look, it can never now close beneath it. It struggles to close. Furthermore, the 20 period moving average from being bearish is turning. Okay, it's been going out, it's starting to turn. Okay, start to turn bullish. And what we can see is here is that price pushes down to the 20. Okay, can't break it, or rather it breaks it, but it can't close beneath it. And also we start to provide, it starts to provide us with bullish reversal signals. So it's giving us an indication that, here's a chance for us to get, in this case, get long into what might well be the new trend. And that's what we're looking for. So, as the slide says there, we're looking for the 20 period moving average to act either as the new roof, okay, for shorts, or as the new floor for long. So, in this case, we've gone from being a roof, okay, to being the floor, okay, to being the support. And as I said, as the 20 period moving average acts as a significant dynamic area of interest, then we can have confidence to trade in the direction of the reversal and the direction of the likely new trend. All right, and that's what we're. This is another way of using that 20 period moving average. Okay, that's what we're particularly looking for. So, once it's changed, okay, once it's flipped, well then, we're just using standard price action setup. So in this particular case here, this candle here, Bush, that is it's a very nice bullish pin bar. That's a very nice bullish rejection candle inside bar. This is what I would call a domino candle. All right, okay, it's just showing us there's the power there. So there is opportunities there too. There's a couple of opportunities to get long into the new uptrend. Okay, that's what we're looking for. We're looking for this as the as a confirmation that the reversal has occurred, and if so, well then let's go forward. Let's have a piece of that. And I've just got a few examples and a few scruffy examples of the truth be known, because it's always easy to pick up the nice pretty ones, but there's a few scruffy ones. So Dow Jones price had been working on a nice uptrend on the daily chart, and this is one setup or one maneuver that you will see is you'll see it plays across all time frames and across all instruments in the way it works. And so we can see that the Dow had been rallying up. It then starts to fall down. Okay, when we get we flip the 20. So if we start to see, once we've closed beneath that 20, and let's just clear the drawings. Once we've closed beneath the 20, the blue 20 there, price pierces it, but it can't close above it. And notice how basically the 20 period moving average is acting as bullish, and now it's starting to slowly reverse. It goes flat, and then actually what happens is we bounce off the 50, we rally up to the 20, and what we have here is very nice bearish pin bar rejection candle, which is also bounced off the 20. The 20 is flipped, all right, and then you can see Bosch, price basically falls down and that will be news the next day. Okay, but the whole idea is to show that this is confirming the end of that uptrend. Now, yes, lots of other traders might say, well, Paul, there's a 1, 2, 3 here, okay, in terms of 1, 2, 3 mover. There's a double top there, okay, of a sense, and that's fine. What we're looking for is just confirmation that reversal has occurred, okay, and that's what's helping me do that. And so I can get ready to position, because the highest probability move is to the downside, and that's absolutely what I'm looking for. Nikkei 4-hour chart, okay, and it's interesting because we can see here, in the downtrend, we can see that basically, we're getting there is, that's, price is bouncing off the 20 there kind of nicely there. That's the way it works. Price is acting as, dynamic resistance. Price pushes up there and falls down again. And then, we hit a big round number, and we put in, that's a big key reversal, big pin bar, which becomes a double bottom again. Okay, here price acts as it's resistance. The 20 is acting as resistance, and price drops and puts in the second leg of that double bottom. But then what happens here is we get a close above the 20, and then if we look at here, what happens is the 20, the price pushes down between the 20, but it can't close beneath it. I mean, if it was to close beneath it, then it becomes a 20 mech entry. But when it can't do that, okay, and the 20 is now started to turn, all right, and going from pointing downwards to going sideways, that's an indication that the reversal is in. And we can see here there's a couple of nice bullish candles there, push ourselves up for the first move, then we pull back towards the 20, and once again, okay, look at how the 20 is now pointing up, and it's acting as dynamic support, and then we get the second move there. Okay, so that's a pretty simple standard move, okay, that you see happening across all time frames on all instruments. That's what we love to see. We want, I always like to share concepts and ideas with you that I call time frame and instrument agnostic. Namely, they'll work on any time frame on any instrument. You might have to meld it a little bit to specifics and nuance of certain instruments or certain time frames, but as a general rule, once we start to see this, it's a very simple way to, as I say, to just confirm that the 20 period moving average, is just helping us confirm that a reversal has taken place, and the highest probability move is in the direction of the new trend, and that's what you can hope for. That's what you're looking for. I've just got, as I said, I had a few scruffy examples, okay, just to basically to show us, the cable, okay, pounding its dollar, pushes up there, closes above it. That actually becomes a 20 mech entry there, but the candle is very, very big. Now, of course, we can see it went down, but you don't know that at the time. That's hindsight. It's using hindsight. It actually does it there. But what we're looking for is price puts in this low here, this double bottom low there, okay, and it rallies up, comes down, okay, and then forms a higher low, and then actually what happens is we see price get squeezed here. It's getting squeezed between the 50 above, but then what we see is the 20 has turned now. It's heading up, and price here gives us a nice bullish pin bar. It hasn't been able to close above 20, and then what we see is Bosch, it actually flies its way up, and our price ended up going all the way back up to 120. So, not you had to wait, you had to have a bit of patience, okay, but not necessarily super pretty, but that's trading. Welcome to trading. It's about, can I identify, can I identify a simple setup that the market is telling me that there is a reversal in place, and this is my opportunity to get onto that new trend. So there you go, ladies and gentlemen, two simple ways that you can use the 20-period moving average, one for trending, one for reversals, to help you with trade setups. So just before we switch across to the live charts, as I said, 2024 will be an eventful year in markets. Okay, we have UK elections, US elections, probably other elections elsewhere. Okay, that might provide us with lots of volatility and lots of interest, and so I hope you'll be joining us on Monday Market Matters to help us navigate through those choppy waters. In particular, for what we touched on today, as I said, moving averages, they get a little bit of a bad rep, all right, but they can actually still be enormously useful trading indicators, okay, in terms of helping us support us with our trading decision. They can be used to help confirm a trend and provide a very simple entry tactic to join an existing trend, which is what the 20 MA MAC entry provides, or they can be used to confirm a reversal in the trend, all right? And whenever we see the 20-period moving average act as either a dynamic support or as dynamic resistance, that after reversal pattern, that starts to give us an indication of what we can expect in terms of the likely trajectory of the new trend. That provides us that opportunity to enter the new trend. But as always, regardless of whether you're joining trends or trading reversals, we always utilize simple and robust risk management principles. That's what we're always talking about. So with that in mind, let's have a little look at live market, shall we? Those US markets have been open for about 13 minutes, so let's see how they are playing out and what, if anything, they're providing to us to start the week. Before I do, just a reminder, join us next week on Monday Market Matters, okay, 12th of February, where the education element will be all about trading a long or a short squeeze, okay, something I talk about when price coils up, how it's getting squeezed, and actually how you can turn that into a trading setup. So if you've not registered for ActivTrades webinars, you can do so either on the website, or as you can see, there's a QR code there you can take a screenshot of, and that will take you to the to the sign up page for that. And as I said, I hope you'll join us for that. So as always, before we just go and look at the live charts, if you want to contact us, if you've got questions or comments or thoughts or feedback, you can do so. Okay, there is the English desk number there, as you can see, or you can email englishdesk@activetrades.com, and they'll be very happy to help guide you. So if you just bear with me a moment, I'll switch across to the charts, the ActivTrades charts, and let's have a look at what is available for us. So just bear with me for one moment. So I'm just very quickly before we look at the live charts, okay, just an example from ActivTrades. Now the clients have the opportunity to utilize the TradingView platform, okay, and if you can find that on the sort of ActivTrades website, or speak to your account representative. They're very happy to help. This is just a very quick. This is PepsiCo on a monthly chart, okay, and one of the reasons I kind of like to use this is because you hear me talking to new traders about how good trends leap off the charts, okay? Good trends leap off the charts. That's what we are looking for, right? And this is a monthly chart, okay? Monthly chart on PepsiCo. And what I just wanted to show was, examples whereby, we can see here, this has been in a very clear trend, which is what we always love. So, opportunities to rejoin, the trend, okay, on the 20-period MAC elements there, okay. There's no particular ideas there, okay, and that very nice trend. But also, where we are at the moment, we can see that the 20 acted as really lovely dynamic support there, didn't it? But we've broken beneath it, and we've bounced off the 50, and now we are we've got the 20-period moving averages going sideways, and last month acted as resistance. It flipped from being support to resistance, and we have PepsiCo earnings at the end of this week, so it might be just something to see, because it might well be that invariably that's the peak, and we're drawing our way down. Or alternatively, maybe we get back up and close back up above that 20-period moving average. So there might be opportunities there. So just wanted to just show you one very simple, opportunity there. Okay, in terms of the different equities on a monthly chart. Not something particularly look to utilize or work, but it's just a very nice example, okay, of how the concepts are shared with you. They are time frame and instrument agnostic, and I appreciate we have people across the entire broad range of trading, okay, in terms of how they particularly like to operate. So let's have a look at our normal. Let's have a look at our normal particular elements here. Okay, let me just bear with me here, and we'll just set up here and let's see what's been going on with the market opening. So let me just here. This is bring up here. This is just a profile I have for the American indices. So Dow there, Russell, S&P 500, Nasdaq. Okay, so I traded on Nasdaq a little bit, Dow a little bit this morning. Okay, and let me just clear these drawings. And what I'm always just looking to see, well, I always say that those markets open at 9:30, so about 17 minutes ago. I always suggest that most traders give them a miss for about the first 15-20 minutes. There can be an awful lot of volatility. Sometimes it's hard to identify what the particular market wishes to do. So I'm always happy to sort of give it, as I say, about 15-20 minutes, and then start to have a look at what is actually occurring. And certainly, what leaps off the chart to me at the moment is that certainly the Russell has kind of opened and pushed all the way down past its Friday's lows to the previous week's lows. That's kind of interesting for me. Otherwise, what I'm also looking at is just looking at the charts as always, just sort of identifying kind of significant sort of levels where price might sort of make a change or a move. All right, just looking at particular highs and lows of the session so far, and previous highs and lows of the previous day. I'm just going to be interested to see. There we go, as we're pushing down there. See how price does that. Let's just go down a little bit. Bang. Certainly you can see there, we had a very bearish open there, and we've just kind of clattered our way through the lows of the session this morning, and we're in that kind of zone there at the moment, just working out as we do. Yeah, it's kind of just double bottoming there, okay, on the sort of 1 minute chart. Okay, maybe let's see if we'll get a base. We'll get a little bit of for the aggressive intraday trader. There might be a little bit of maybe a rally comes up off that way. Looking at the Nasdaq, as I said, I'm just always kind of curious to identify not only previous days and previous weeks' highs and lows, but what have been the kind of lows and highs of the sort of electronic session so far. I want to see how prices are reacting to that. Yeah, that's pretty sort of just in the middle there, Nasdaq. Okay, those of you who joined me in the past, what I like to see is I like to see all of the indices in correlation, as in moving together. When there's a breakdown in that correlation, that's when I start to get a little bit nervous. Okay, it doesn't really suit my particular trading style. But actually we can see that the Russell's leading us lower. Nasdaq seems to want to follow it. S&P 500 was kind of holding up a bit. S&P 500 was very quiet, really. So let's just look at what have been the kind of session highs and lows for the day so far. We're already kind of at that there. Yeah, big numbers. No, nothing there. So yeah, on an intraday basis, I mean, it drifted lower, but it's not in the same way that Russell and Nasdaq are pushing lower. Okay, I'd say actually that has just been, even if you just look at that on the 1 minute chart, for the first 15-20 minutes there, price is just literally bouncing around in quite a small range there. What between about 49.63 and 49.69. So 6-7 handle range there it has been for the last 20 minutes. So it just adds to kind of my my guidance that for the first 15-20 minutes let the chart do its thing. Okay, let the market do its thing. Okay, don't try to fight that. Now it looks like there you go. Looks like the Nasdaq is leaving us lower as well, or taking us lower. And so then, of course, as I said, we'll be looking at where are the particular significant lows. There was there's a kind of a swing low there that we're getting close to, and so I'm always interested how does price react at those levels. That's what I'd be. We've got a bearish bias. The question is how is price going to react at that level? So that's what I'll be watching for. Yeah, I'd probably say the Nasdaq. S&P is holding up. But yeah, certainly Russell's led us lower, Nasdaq's lower, Dow is leading us lower. So there's that little bit of a bearish start to the day. Perhaps, well, it could be 101 reasons. All right, what we're interested in is just how does price react? To have a quick look at the Russell. Tell us Russell's holding up. Russell's holding up there at that particular level at previous week's lows. There we can see it there, kind of holding there. So I'll be watching to see how does price react. Does it hold there and base before it flips its way up? That's what we'll look at there. So we'll come back to that in a moment. Let's have a look at the sort of the dollar whilst those indices are working their way out. And we have talked in the past about trading the US dollar. So this is a dollar profile, and dollar profile here. So what I have here is Aussie dollar, Euro dollar, Pound dollar, dollar Swiss, Kiwi dollar, dollar CAD, dollar yen, okay, and the dollar index. This is really just a dollar against all of the majors. All right, that gives me a great indication of where's the strength and weakness within these particular markets. And so, always looking at the dollar index. Bang. If you look at the dollar index in the weekly chart, you can see from the end of last year, it has been the dollar's been pretty bullish after that kind of last Q4 sort of kind of collapse. We've kind of rallied our way up there. And for me, what's important is that we basically have we pushed through the 50 and closed above it. Last week we had a really strong week. Okay, and that last strong week, if we look at it on the daily chart. On the daily chart, price had just been going sideways for about 2-3 weeks there. Nothing really terribly exciting, okay. But interestingly, what we have seen is that 20 is crossed above the 50. All right, as I said, I don't like to utilize moving average crossovers, but it does kind of help support what you can see from the price action, namely that we're breaking higher. Okay, that dollar strength is back in vogue, and you can see how that has played out in itself. Kind of just as just a little example here, okay, in terms of what we saw was once price sort of topped out, price dropped, and then it came back up here, and then we can see the 20 period moving average is sort of kind of bounced off the 20, didn't it, before it fell, comes back up to the 20. All right, there it closed back beneath that 20 moving average MAC. Now it's a big candle, bigger than normal, but you can see it kind of worked its way down, and then we kind of reversed here. And then you can see once we go above that 20 period moving average, it couldn't close beneath it. Couldn't close in here. The 20 is resistance. Here it's flipped and become support. Okay, it's become support there, and then bosh. That's what we see. Basically, price moving there. And we can see even here it's still support, isn't it? That's the 20, and the 20 is now it's turned there and pointing up. It's telling us what we want to know. The higher probability is a move to the upside at the moment. Okay. So especially when it comes to trading effects, why would you want to fight the dollar? All right, why would you want to fight? The dollar's the strongest. Why would you particularly wish to fight it? That doesn't really terribly make great sense there. And so, of course, on the flip side of that, we get lots of people who like to trade euro against the dollar there. And you can see, on the weekly chart, that dollar index, we had price rising for a good few weeks, couple of months. Well, it's the opposite. It's inversely correlated with dollar index, and you can see for yourself that it's been basically drifting its way down there in that particular sense. And the daily chart, okay, having peaked, we fell, all right, and then what you can see is we started closing beneath the 20 which had been, the 20 which had been price had been drifting its way up. Started to flip, okay, and it couldn't close above the 20 anyway. On the 20 then started to roll over, and the price got beneath the 50. We came back up to here, the 20 and the 50 were, and then price is drifting its way down there, okay. And that is just, we can see the 20 has rolled over. It's gone from being resistance, okay, there was resistance there to rolling over, okay, and providing resistance in that direction as well. So just looking at ways and means to kind of use that 20 to help you, decipher and identify what, if any, trend there is in the dollar. And if there is a good, strong trend in the dollar, then why would you want to fight that when you could, when realistically you are looking to ride and to work with that. All right, let's go back and have a little look at how these indices doing, like 10 minutes later on, see how they're doing. As I said, it'll be interested to see what the sort of the tone is. Yeah, that's interesting. Yeah, so yeah, it's interesting. The Russell has continued. The Russell has kind of continued down. There's only 4 minutes for that candle to complete. But look at the Nasdaq. Interestingly, okay, gosh, we were down towards the kind of previous lows, etc., and the price action is looking to, like, it's going to reverse off that a little bit. Okay, come back into the range where it's opened. The Dow looks like, I wonder if that might follow it. Certainly on the 5-minute chart. If we go down to the 1 minute, yeah, saying it's kind of looking like it's double bottoming there, but it's not really following through, is it? It's not really. I'd be looking there, even on the 1 minute chart. I'd be looking to see, can price get above the 20 and hold? If it can't, well, that in itself is probably not giving you a great confirmation of the reversal playing out. So we'll just keep an eye on that. S&P 500. S&P 500 is still really kind of, it's in the middle of its range there. If you look at that, it's just in the S&P 500 is just in the middle of where it's open there. Okay, it's still in that. What's that? In that sort of six handle range. Okay, there's there's not a great deal of clarity on this particular Monday start. All right, so I'll be watching that. I'd probably be maybe a little bit, my natural inclination bearish, but as you hear me say, I like to see all of those indices in correlation mode. I like to see them all moving in lockstep together. When we've got the Russell very strongly bearish, okay, S&P going sideways, Dow now kind of sort of going sideways, all right, and the Nasdaq undecided. That just kind of that always kind of makes me a little more dubious when it's like that. I will wait and let the market show its hand. I don't try and fight the market. I don't try and project what I want from the market. It's about, well, what does the market want to tell me? What does the market want to do and stuff? And let me just, if I look at that, I've got, let's put these down here on that. Bang. So, kind of Nasdaq is trying to push up, Dow is trying to push down, S&P is trying to push up there. Okay, so Russell, that might be on the minute, but it's definitely down and stuff. So as I said, there's no real clear trend there at the moment. So when there's no real clear trend, that's I tend to just be happy to sit and watch for 10-15 minutes, let the market play out. It generally is a better way to operate, is to let the market show you its hand, let the market tell you what it wants to do. The market is always communicating with you. It's up to you to learn how to read the signals that it's sending there to you. Okay, ladies and gentlemen, well, it looks like we've come to the end of our time together anyway, unfortunately. So I hope you found that useful. I hope that's given you a little bit of insight into how you could utilize the 20-period moving average, both in terms of trends, both in terms of reversals. Okay, so go away and have a look, and just have a look at and see how the price reacts around that 20-period moving average, because that can always be very, very helpful. So Gary says, thank you, Paul. As always, your knowledge and teaching is really appreciated and very helpful. That's very kind of you to say, Gary. Thank you for joining us. All right, hope as always you try and share concepts and ideas that you can utilize in your own trading. Remember, next week on Monday Market Matters, we'll be talking about trading a long or a short squeeze. I hope you will join us then. And until such time, trade well, everybody. Have a great trading week, and I will speak to you soon. Many thanks.